Hey, welcome back to My Opinion. I have another real estate question. Someone wrote in was telling me that the banks were giving them a hard time and they want to know should they back out, wait till they repair their credit, or what should they do to handle the banks. Well, let me break it down to you. Banks give everybody a hard time. I don't really care what your credit is unless you have perfect credit. That's just what banks do. The reason why they give you a hard time, they make it difficult on you because so that way they can raise your rate, your interest rate. The more they raise your interest rate, the more money they make. And banks, what they do is a lot of companies that give you the loan up front, the mortgage up front, they sell your loan off. And so other banks and other systems buy it because they, based on your credit and the money to be made off of your loan, they'll purchase that loan. So they give you a hard time up front for that reason. Now, what happens is, depending on your credit scores, it affects your interest rate. So if you have one of the best interest rates, they're still making money because the way your loan is structured for the first, your loan is on a 30-year amortization. So over that 30 years, most of those first, I say 10 years is just mostly paying out interest rate to these companies. And then after they collect a little interest, then they sell it over to another company. So they want to make sure that they're thorough. They want to make sure that they have crossed their T's and dotted their I's, that when they sell your loan is a good loan, that another bank will say, okay, it's a little bit of meat on the bone here. We can make money off this person. So we'll buy this loan, we'll make a little bit of money, and we'll carry this out full term, or they may even sell it off to someone else. So definitely I would stay in there. I would definitely fight that fight because it's worth fighting, because once you go out and you take the time to go repair your credit, depending on what's on your credit, what you have to get off, if they approved you, I don't know how much it will adjust your scores to drop your rate down that much more, because most times that when you have stuff on your credit, once they approve you, they kind of know what you can clean off and what you can't. If you have like a lot of little outstanding loans, sometimes what they'll do is they'll make you consolidate a lot of those on one credit card, so you only owe one creditor, which looks good on their portfolio of your loan that they have made up for you. So when they go sell it to someone else, they say, okay, he doesn't have a lot of debt. Your debt to income ratio, meaning the income that you make and your debt that you pay out, they have a ratio that you have to be in. They don't want you to go over 50% of what you're earning that you pay out in bills. So it makes sense what they do and why they do it. Unfortunately, on your end, it's more headache than what you feel you should get, and I totally understand that. Another thing about that is that banks definitely, once they start doing this loan process, they try to pull you in as deep as possible as they can, meaning they want you to put down as much money as you can, because that shows commitment on your end, but it also helps them once they sell your loan again, because that's what it's all about. It's all about how they can make the most money off you the best way that they can. So pretty much I hope that answers your question on it as far as the banking system, because the banking system is a joke. I mean, really it is. Unfortunately, there's no way around it. If you go to another bank, they see that these other companies that they've pulled your credit scores, and the more that you go, the more your credit scores drop. So it's kind of like a catch-22. They're all working together, and yeah, they're really much out to get you, unless you have superb credit, which hardly any of us do. So the best thing you can do is maybe go to one or two different companies to see. I wouldn't go no more than 3 companies, because once you start pulling more, those hard pulls, because those are not soft pulls on your credit report, those are more of a hard pull, and it kind of brings your scores down a little bit. So if you're borderline, let's say if they said you needed a 640 credit score to get a 95% loan, and your credit score is probably 645 or 646, well, you keep pulling those credit reports and keep going to these different companies, your credit scores can easily fall from a 645 to like a 639. And if the 640 is your cutoff and you hit 639, they will not do the loan. Let me tell you that again, that scenario again. If your credit score is a 645 and you keep going to different lenders and they keep pulling your credit and it drops down under the 640 cutoff, they will not do the loan at 639. They won't do it. They have strict guidelines that they follow. They don't care how much you cry about it. They won't do the loan. So be careful about shopping. And it is like lender shopping. So basically what you're doing, you're going to different lenders, you're shopping, trying to see which one's going to give you the best deal. They kind of all going to give you about the same deal depending on which company. Like if you're with Wells Fargo, and if you bank with Wells Fargo Bank, they might give you a better rate. Or Bank of America might give you a better rate because you're a Bank of America customer. So kind of go to your banking institution first if you can, if you have that good credit. If not, go to a credit union. Credit unions kind of help people out with not the best credit in the world, where you don't have to have the 850, but if you're a hard-working person and you kind of pay your bills on time most of the time, credit those smaller institutions will help you out. So, like I said, I hope this helped you out. If it didn't, please hit me up with more specific questions, and I will answer it the best of my abilities. Until next time, talk to you later.